Welcome to RP Data's update on housing market conditions across Australia for June 2012. Last month we saw capital city dwelling values fall by 1.4%. That's the worst results we've seen since 2008 at the height of the GFC. The result also comes on the back of a 50 basis point cut in official interest rates. Expectations are going forward that we will see up to 100 further basis point cuts from the Reserve Bank over the remainder of 2012. The cumulative decline in capital city dwelling values is now 2.2% over the first 5 months of 2012 and 5.3% over the last 12 months. And since dwelling values peaked back in October 2010, we've seen them fall by 7.4%. The falls in home values have been more pronounced across the detached housing market compared with units. House values are down by 5.8% over the past 12 months, while unit values have fallen by a lesser 1.5%. There's further variation from region to region. At one end of the spectrum is Adelaide, where dwelling values are down by 2.4% over the last 12 months, while Hobart values have recorded the largest decline, down by 8.9% over the year, followed by Melbourne, where values have fallen by 8.4%. Additionally, there have been considerable differences in the housing market performance across the broad price ranges. It's the most expensive properties that continue to drag down the overall index. The top 20% of capital city suburbs based on price have seen a value reduction of 6.1% over the year, while the most affordable 20% of suburbs have recorded a loss of just 1.5%. Some positive indicators are evident in our measurements of vendor metrics and transaction volumes. The average selling time has seen a subtle improvement, with typical capital city now taking about 63 days to sell a home, which is an improvement from the seasonal highs recorded earlier in the year. The levels of vendor discounting are also showing some improvement, with vendors reducing their initial asking price by 7.1%, compared with a high of 7.9% mid-last year. Additionally, auction clearance rates have levelled around the 50% mark, which is about 5% higher than the average from the second half of 2011. Our estimate of transaction volumes has also seen an uptick, with a number of house and unit sales over the month of March at their highest level since March 2011. Each of these indicators, despite some showing improvement, remains well below what we consider to be normal levels. Buyers still hold the advantage in this market, particularly when you look at the number of homes being advertised for sale. We're counting about 308,000 homes available for sale at the end of May. To put that figure into perspective, back in 2008 there were about 60,000 fewer properties available for sale nationally. Listing volumes do appear to have peaked, with the total number of homes listed for sale about 9% lower than when they reached a record high late last year. New listings being added to the market have been trending downwards, which is another positive sign that effective supply levels are now easing. Market conditions are quite different from city to city, so here's a brief wrap-up of where each capital city lies. Sydney's housing market has been relatively resilient to value falls up to May. May saw somewhat of a change in that trend of resilience, with Sydney dwelling values falling by 1.2% over the month. Since Sydney dwelling values peaked back in November 2010, they've fallen by a cumulative 5%, which is the second smallest fall from peak after Adelaide. Sydney's unit market has been much stronger than the detached housing market. Unit values have actually improved over the past year, rising by 0.8%. Rental markets remain reasonably tight across Sydney, providing some improvement to rental rates over the past year. Rental yields are around the capital city average, with houses returning 4.4% gross and units 4.9%. The Melbourne housing market has continued to show a more significant correction than other capital cities, a phenomenon that can be attributed to the high rate of capital gains during 2007 and during 2009/10 that has eroded rental yields and created some affordability hurdles. Additionally, the Melbourne market doesn't have the same sort of supply constraints that are evident in much of Sydney and Brisbane. Melbourne values are down by 8.4% over the past 12 months, and since the market peaked back in October 2010, values are down by 10.5%. Rents are fairly flat across Melbourne, and yields for houses remain below 4%, and unit yields are at 4.5% gross. The Brisbane housing market recorded a fairly resilient performance in May, at least relatively speaking. Values were down by 0.3% over the month, and the annual rate of decline has improved to 6%. Brisbane has seen dwelling values fall by 12.2% since they peaked earlier than most other capital cities back in November 2009. The slump in Brisbane property values, together with higher rental rates, has provided Brisbane with rental yields that are well above the capital city average. Houses are now returning 4.7% gross, while units are providing a 5.6% gross return. The Adelaide housing market has seemingly defied the slowdown affecting other capital cities. Dwelling values were up 1.2% over the month of May, and they've fallen by a relatively small 2.4% over the past 12 months. The resilience in the Adelaide housing market seems to be mostly due to an improvement in conditions across the most expensive end of the housing market, a trend that's opposed to most other capital cities. Over the last year, Adelaide's most expensive suburbs saw values rise by 3.1% compared to a 4.1% fall across the most affordable suburbs. Rental markets in Adelaide remain reasonably flat, and yields are tracking around the capital city average for houses at 4.3%, while unit yields are below average at 4.5%. Perth's housing market is continuing to stage a tenuous recovery. Values saw a 1.7% fall over the month of May, but despite the weak result in the month, we've generally been seeing the rate of decline improving in Perth, with the annual fall in values now just 3.9%, which is a slightly better result than the combined capital city average. Perth rental markets are absolutely going gangbusters, with house rents increasing by about 16% over the year and unit rents rising by 11%. Rental yields across Perth are now slightly higher than the capital city average at 4.4% gross for houses and 4.7% for units. The housing market in Hobart continued to suffer over the month of May. Values fell by 1.2% over the month, and they're down by 8.9% over the past 12 months, which is the largest fall of any capital city. The lower dwelling values have provided rental yields that are above average, with both houses and units providing a gross yield of 5.3%. Home values in Darwin saw a 2.4% drop in May. However, the trend in Darwin home values does seem to be improving. Over the past 12 months, Darwin values are down by just 1.2%, which is the second smallest fall in dwelling values after Canberra. Strong employment conditions and limited land supply are likely to be the main drivers of improving market conditions. Rental yields continue to be the highest of any capital city, with houses returning 6% and units 5.9% gross. Housing values across Canberra have held up reasonably well since market conditions started sliding. Canberra dwelling values have fallen by just 0.9% over the past 12 months, and values are down just over 5% since the market peaked. Canberra rents have remained reasonably flat over the past year, and houses are providing a gross yield of 4.8% and units 5.8%. The cash rate is down 100 basis points between November last year and May 2012, and the banks have passed on about 75% of those official rate cuts. Interest rates take some time to have an effect on housing market conditions, so the May results may not reflect the cheaper interest rate environment and subsequent improvements to housing affordability that became apparent over the month. However, the interest rate falls have not yet translated into an improvement in consumer confidence readings, an indicator which should be much more responsive to the rate cuts. Most economists are expecting interest rates to fall further, with Westpac recently predicting that the cash rate will be 100 basis points lower by the end of the year. The forecasts are based on further deteriorations in the Eurozone, some loss of momentum in the US economy, an ongoing softness in local consumer sentiment, and the widening gap between the cash rate and the standard variable mortgage rates. Based on the outlook for interest rates, if we don't see housing market conditions improving over the coming months, it may suggest that consumers are simply too wary of global and domestic uncertainty to be swayed by the lower interest rate environment. It's likely the Reserve Bank interest rate decisions will be even more keenly watched by anyone with a passing interest in the housing market. It should be an interesting couple of months ahead. This month's question comes from Cameron in Brisbane. Cameron is wondering how vacant land prices are tracking. Considering the slowdown in housing markets, are we seeing a similar trend for vacant land markets? RP Data does analyse conditions across the vacant land market. In fact, we release a quarterly vacant land report in conjunction with the HIA. Interestingly, the vacant land market has shown some differences to housing. Firstly, the number of land sales has shown a sharper slowdown than what we've seen in the housing markets. Total land sales are almost 40% below the decade average at the end of 2011. Importantly, the median price of vacant land has held fairly firm since 2010, highlighting the fact that land prices are being somewhat buoyed by a lack of supply, and there's probably the additional issue at play that developers can't cut their margins on vacant land holdings any further than what we've already seen. Land sizes have been trending downwards for quite some time though, which also highlights that although median prices are staying fairly constant, on a rate per square metre, land prices are actually rising. Once again, thanks for tuning into our overview of the housing market conditions around Australia. If you're interested in more detailed information, we recommend you visit the research tab at www.rpdata.com.